My name's Ed Legget. I've been a UK equity fund manager and analyst for over 20 years, looking at the UK market. I've been at Artemis for the last 7 years and are one of 10 fund managers and analysts looking at the UK equity market. Alongside my co-manager, Ambrose Folks, we manage a strategy called the Artemis UK Select Fund, which we're talking about today. The Artemis UK Select Fund is a multi-cap fund, so we can go from the very largest to the very smallest companies in terms of where we invest. But what we're looking to do is compound long-term returns. And we're seeking to outperform the FTSE All-Share, reasonably significantly over time. And we believe that if we can do that consistently through time, which we have done over the last 7 years and prior to that with a similar strategy that I was responsible for at Standard Life Investments, then we can create an outcome for clients which is very different from the FTSE All-Share. So we have a simple investment philosophy, which is the cash flows of the companies that we own will correlate very strongly with our long-term returns. So we're picking up those cash flows through time as long-term owners of UK equities. And as such, we're looking to invest in companies whose cash flows are going to grow through time, as that's important in terms of generating real returns for our investors over time. But equally, the world is always changing. Economic cycles come, investment cycles come. And we're looking to invest in companies when multiples are low and have an opportunity to recycle that capital as multiples expand into other areas perhaps the market is worried about. And certainly, a big underpin of our investment philosophy has been a focus on a constant 3-year time horizon. In times of stress, market participants have a very short-term time horizon. In times of euphoria, people get too excited and discount growth years and years in advance back to today. And by keeping that constant time horizon, there's a real opportunity at some of those times of stress to pick up, phenomenal companies, great franchises that, significantly below their long-term value. You could use an example in COVID where, you could buy pub companies at 25-30% of their freehold book value. You could buy high street retailers, again, at very low valuations versus their long-term history. So in terms of fund performance, our aspiration is obviously to outperform the FTSE All-Share over that 3-year rolling period. If you look at 1 year specifically, we're helped by, the fact that this time last year we had the mini budget, the sterling crisis, the bond market crisis in the UK. And as a result of that, we've seen, a very big rebound in some of the consumer cyclical stocks in our portfolio. So the fund's up just over 30% on a 12-month view to the end of September. The stock market is up 14% on total return on the same basis. So it's been a good year for the fund on a 12-month view. But going into that, if we'd looked 6 months before, the performance numbers would have been quite different. On a 3-year rolling view, the fund's up 16% per annum versus 12% the broader market. And on a 5-year view, those numbers are 7% for rounded to the nearest percentage. So the fund is because we're biased towards free cash flow, we tend to own companies that are at the cheaper end of the market spectrum in terms of conventional valuation multiples. But we actually think we own companies that are growing through time, and they're at the cheaper end because generally, in average across the cycle, they're perhaps more cyclical companies. So historically, the fund has underperformed at stages of big economic shocks, not always, but we've hit more of those periods of underperformance than not. But having that 3-year time horizon gives us the opportunity to take advantage of that when it comes. So it's, external macro shocks would tend to be areas where risk assets in general underperform. And, some of the companies historically won't always be the case that we've had have underperformed in that environment. But where things have changed, we will change the portfolio to reflect the new environment we're looking at. And I think we have a pretty strong track record of capitalizing on those opportunities and seeing performance recover strongly. So the numbers we talked about over 5 years, over 3 years will incorporate COVID. But there were, a quarter or 2 quarters within there where, the fund, underperformed the index that, relatively meaningfully. No, we look at total return. So we're agnostic between capital growth and income. As I say, the free cash flow that companies generate, we believe is what we'll get over the long term as long-term holders of UK equities. And, if companies can reinvest that free cash flow into their business and generate attractive returns, great. If they haven't got enough opportunities to invest that cash flow, then equally, we're happy to see that cash flow come back to us either as dividends or as share buybacks. And certainly share buybacks is something, given the very low valuation of the UK stock market at the moment, something that's becoming increasingly popular amongst, the listed companies in the UK. I think as we look ahead, we have had a view on the UK economy for the last, 24 months that it's the UK consumer in particular is just not quite, is not as bad a place as the media and the press would have you believe. And I still think as we look through into next year, we're seeing real wages grow again. You're seeing inflation come down sharply, and inflation will come down sharply again in October, given the movements in utility bills year on year. And as real wages start to grow, we think consumer confidence will continue to pick up, which it has been doing from a very low level over the last 6 months. And as consumer confidence picks up and as real wages improve, we expect that consumers will start to spend a bit more. So we see the UK economy growing next year, sort of 1 to 1.5%. The consensus is closer to 0 to 0.5% next year. And against that backdrop, I think similar to, sitting here today versus sitting here a year ago, you just need perceptions to be less bad for companies to re-rate. The best performing stocks, as I said, have been consumer cyclicals over the last 12 months because of where you were at the starting point, as opposed to necessarily exactly how they've traded over that 12 months. So I think you've got that. And then lastly, we've got the election clearly next year as well, which I think, again, perhaps given the chaos of the last few years, a clearer outcome and a clear mandate for a new government, I think, again, might, for the international investor, remove some of the negativity attached to the UK economy.